All right, we'll be getting started now. So, hi everyone. Thank you for joining us today for Paapo's very first webinar, and we're really excited to have you here. My name is Tosin Adegun. I'm the founder of Paapo, and I'm also joined by Nicholas Allo, who is also the co-founder of Paapo. So, thank you so much. We'll go on to the agenda now, Nicholas. As you can see, we have a very packed agenda today. We'll be covering quite a few topics. We'll talk about the practical ways and actionable steps you can take to make sure you're money ready for 2025. We'll also cover the kind of money habits you need to get rid of and the ones you need to replace them with. It's going to be really exciting. And we'll also have a live Q&A session at some point during the presentation. But as the presentation goes on, we would encourage you to drop your questions in the chat, and we will take it on as it goes on. And I'm sure you're thinking, why are we having this event? The reason why we're having this event is that there are so many challenges affecting our finances at the moment. One is the cost of living crisis, the stubborn inflation, as well as the effects of the autumn budget. And with all these things happening, it's very important that we're quite mindful about how we manage our money. And we've also noticed that there's a particular segment of society that is quite underserved by financial services, which is your Black community, refugee communities, as well as immigrant communities. So this is why we're doing this. And I am really excited to have Naomi on board, because I think I met Naomi around 2 years ago at a work event, and I was absolutely, totally blown away. And I'm so delighted that she's here today to speak to us. So Naomi is a former bond trader, and she's now an authorized financial services advisor, and she has over 20 years experience in financial services. She's absolutely brilliant, and I can assure you guys today you're going to really enjoy today. So Naomi, I can see you're already smiling, already ready. So over to you. You need to tell us what we need to do to get money ready for 2025. How can we make our money work harder for us? So pray tell, over to you.
Okay, what an introduction. Well, thank you so much. Thanks for having me here. Just congratulations, Tosin and Nicholas, for such an amazing initiative. And also, thanks to everyone for joining and anyone watching on replay as well. So it's great to be here. But Tosin, you hit the nail on the head. How can we get money working for us? First of all, little bit about me. The topic of money is complex. Money and finance is something that is full of jargon and also full of emotion for a lot of people. So this session is very much about how we can all get our money working harder for us. So I may not know all of you on this webinar, but I am sure that you all work very hard for your money. So I'm going to start everything off with this question. Is your money working hard for you? So let's go through what we're going to chat about today. Now, probably you can't really start looking into the future without at least having a little bit of a look as to kind of where we've been as well. I want to kind of talk to you about creating money goals, and then I want to give you my top 5 recommendations to have a financially empowered 2025. So hopefully you're all ready, and let's get going. With a 2024 MOT, let's have a look at how 2024 was for you. So I'd be really interested to know, ask yourselves, did any of you have any money goals or New Year's resolutions for 2024? with regards to your money and your finances. So I think that's really important. And don't worry, by the way, this is not you don't have to kind of obviously all start putting your hands up or anything like that, but just think to yourself whether you did that. And it's also not a test. There's no right or wrong answers or anything. One thing I also wanted to say that a lot of you may not complete self-assessment tax returns, but maybe if you're self-employed or if you have different income from different places, maybe you do complete a self-assessment tax return. Well, we're in December already, and I know a lot of people that do complete it usually wait until the last minute. I mean, if it doesn't have to be completed until the 31st of January, why do anything sooner? I would say first thing you should probably do in the year in April is have a think about your tax return or think about any changes that happened the previous year. And it's much better to alert the Inland Revenue. It's much better to get everything done whilst it's fresh in your mind with no panic. So as you may have guessed, I do mine right at the beginning of the tax year, and it means that I can sit back and relax, but also when I spot that there are mistakes out there in things, and actually I spotted a huge whopper of a mistake in my state pension national insurance record last week, you've got time to do something about it. The other thing is the autumn statement in 2024. So that was 30th of October, the budget. You know, what does it mean to you? Now, it meant a lot to really businesses, small businesses in particular, but maybe if you work in the retail sector, maybe if you receive carers allowance, maybe if you are on a low wage, all of these factors mean that something in the budget will have an impact for you, both positive and negative. So it is important kind of having a think, do you know what it means for you? And don't worry, even if we don't touch on things during this call, one thing that we're going to be saying all the way throughout is never be afraid to ask questions. And we'll get on to all of that. That's ask questions now, but ask questions throughout the year. Never be worried about money. Never have something happen and you don't understand. Make sure you know people that you can ask or get on newsletters or find places that are easily accessible for you so that you can have your questions answered. And have a think about how you want to end the year financially. We've only got a few more weeks left of 2024, and that's scary. But have a think at how you want to end it. And in particular, I'll ask the question, is January always a tough month after an expensive December? December tends to be really expensive for most people. It's a time of Christmas, so maybe a time of presents. It's also a time when there are sales on as well. So people tend to spend a lot of money in December, and we all tend to feel like we're hurting in January after that. So if that's how it works for you, let's start thinking about 2025 and start formulating ideas on how we can make 2025 a much more positive year if you've had any pain points, misunderstandings, anything at all throughout 2024. So let's go. Okay, so 2025. Some people don't like the concept of New Year's resolutions. So if it is something that frightens you, don't worry about that. Let's try and think about introducing some new money habits for 2025. So we don't have to put the stress on, don't have to worry about a goal and how that all is, but let's try and see if through small increments you can have a much healthier and happier financial 2025 than maybe you've had before. So I'm just going to get cracking and we're just going to go straight on to one idea for some positive money habits. Now do bear in mind, in my role, whether that's here today, whether that's advising or helping people plan for their futures, I am just there to answer questions, to help you see what your options are. I'm never going to tell you what to do. Nothing's necessarily right or wrong. So don't think that I'm here telling you you have to do everything. Do feel that you can pick and choose if anything you feel would work for you, because not everything works for everybody. So I like to think of, when we spend money, do we do it intentionally? So I thought of this concept of mindful spending, and making sure that when I do spend money, um, that I am intentional about it and purposeful with it. And that can very much help you when you're working through 2025 and beyond, and being much more maybe savvy with your money and creating some good habits. So I don't know if anyone's heard of top-up cards. So a top-up card is not a credit card. It's like a reloadable card, so a little bit like an Oyster card if you use that in and around London, or if you use reloadable cards for your phone, mobile phone, for example. It's a little bit like that. So it's a bit like a debit card, but you load money onto it. These can be really powerful for spending your money, because if you've got a budget, let's say you're going to the supermarket and you've got a budget of £40, you cannot spend more than £40. If you've got £40 only on your card, that can help you much more. Maybe put back some of those extra treats, and I'm really bad with that as well myself. So having a top-up card does help me be a lot more mindful and a lot more intentional about what I'm spending, because I am restricted because I only have a certain amount on my top-up card. I also think that sometimes writing it down. Now, obviously, if you're in the supermarket, you're not necessarily going to be able to write down everything, frozen peas and, a kind of bag of apples, or anything like that. But in particular, with today's internet and online shopping, sometimes it's very easy just to spend money on a whim. So I've come up with a few ways that can help us be a bit more intentional about that. One way is actually just to write it down. If you're on an online shop, you see something you like, I actually email my husband, or I'll email and say, what do you think of this, and send a link. And that just makes it a little bit more intentional. But even if you just get a piece of note paper, write it down, write yourself a little note about it. That can help you be a bit more mindful. I also developed a little thing about saving a portion. Now, this isn't necessarily on my weekly essential spend if I'm in the supermarket or if I'm buying something, but if I'm buying something that's a little bit more luxurious. So I'll give you an example. So last year I bought a new coat. I was actually looking forever for a coat, and I actually found a coat. It was on discount, but I needed a coat because my old one was literally falling apart. But what I thought was that if I can afford to buy this coat, can I afford to put 10% of that into my savings account as well? And so it made me really think about that, because if you can't, if you're like, right, I can afford this more luxury discretionary item, well, I can't afford to put, if you're buying something, again, let's use that. So let's use the £50. If that coat cost me £50, can I afford to put £5 into my savings account? If I can't, the question may come about, can I then afford that coat? Helps you be a little bit more mindful about what you are spending on. Also, something else I did as well, since it was on discount, I took that discount that I was saving by buying it in the sales, and I put the amount that I saved it also into my savings account. So I was spending the full price on the coat, but I was also putting that into my savings account. All of these really can help to be more intentional about what you're doing, whilst also building really healthy money habits and a really good savings account. And we'll look at savings a little bit later. I also have a 3-day rule. This is really helpful for internet shopping, but also for window shopping. You find something that you like. I have a 3-day rule. Some people prefer a 24-hour rule. Unless it's essential item, unless it's absolutely needed, like food, don't have to buy it right now. Maybe put it in your online shopping basket and wait 3 days. And if you still want it in 3 days, that can help against impulse buying. Okay, so the next thing I wanted to chat about was paying off debt. So again, really good money habits can come with making sure and trying to pay off your debt, because sometimes debt can be really overwhelming. So just a few things that I want to mention. Not all debt is equal. Okay, so being a little bit more planning and being a little bit more intentional about how you pay off your debt can really help to either speed it up or to at least make you feel that you're accomplishing something as well. So I wanted to talk about a couple of methods. Now there's the avalanche method. A lot of people prefer this method because it's basically prioritizing paying off your highest interest rate debt first. Do you have credit card debt? Do you have overdrafts? Those tend to be the really tough ones, or in particular as well, payday loans, so really short-term loans as well. Think about starting to pay those highest interest rates off first. Psychologically, though, that may not work for everybody, which is why there's the snowball method. Because it could be that your highest interest rate's your largest loan or credit card that you've got, and actually it can feel really difficult if you're not able to pay that off, or at least see an impact. So the snowball method talks about, why not just pay off the smallest debts first, because then you really can feel a sense of accomplishment. That's really important as well. So if we're building money habits for 2025, think about debt that you've got and think about what you can do, how maybe you can start paying each one off or prioritizing paying them off. Now, one way to do that, very easy usually with credit cards, is I call it minimum plus. You all have minimum payments that you need to pay, but in a lot of cases that counts for loans. It can even count for mortgages, although I've put those lower down on the list because they tend to be the largest and they tend to be the lowest on an interest rate scale as well. Pay off more than your minimum payments. That can really speed things up, and again, psychologically can be much easier. Having a spending plan and budgeting is really important. Now, I don't want to be the one to stand here and say, look, you know, you've got debt, what can you cut back on? And I know that with the cost of living crisis and with just costs constantly going up, it's really difficult. But we're going to look at budgeting in a little bit when we start talking about actions in those top 5 things. But if there are things that you can do and have a think about ways that you can save in some respects, maybe even just using the 3-day rule on something, you're spending less, could that help you redirect anything that you're saving into paying off some of your debt? The last one I do want to just say, just be careful with, and in almost all cases, I'd say speak to a professional, get some advice, read the small print. But if you really are overwhelmed with lots of different debt, particularly high interest rate debt, balance transfers onto 0% credit cards, even remortgaging or getting a loan consolidation with the help of advisors is a really good way to go. So the next thing, building money habits. In fact, the last thing in terms of money habits that I wanted to chat about is savings techniques. Now, I've already mentioned a little bit of these, but saving is about is a really strong money habit that you can get. It's not an easy one to do. But you need to start by thinking and finding a really good savings account. If you're not sure, we can send a link to all the to some of the top interest rates, or just ask a question about that. But make sure that you've got at least 4% on that in a savings account. Make sure it's easy access if it's something that you're going to need to get hold of. I don't know if anyone's heard of a roundup account, But roundup accounts are amazing. I know some providers called them save the pennies, but this is a really powerful technique to saving without realizing. So you can get with Starling Bank, you can get with different apps like Plum and Emma, you can get these with different kind of financial services providers like Moneybox. Roundup accounts, what they do is they keep track of all your spending, and any spending that you do, they say, let's round up each individual purchase to the nearest pound. And with that roundup, we put it into a savings account. So let's just say you have gone out and you have bought something for £2.70. What the roundup account does is it takes that £2.70 and it takes that 30p and allows you to put that 30p into savings. So if you're spending £2.70 or spending £3, in many cases, you're not going to notice that 30p, but you will notice in your roundup accounts, it really starts ramping up. So I found that as a really valuable way to help me save as well. And I've saved a lot over the years. Maybe it says more for the amount of money I spend, because obviously the more money you spend, the more roundups there are, but that's for probably another conversation. I mentioned saving a portion of spending before. So if it was a luxury item, maybe you can put 10% of that into your savings account. So I would think about anything that you do spend on that maybe is not essential. Have a think about a percentage that maybe you can just put into a savings account. So it's literally what you're doing is you're treating yourself now with that purchase that you're making, but you're also treating future you by building a really good and positive money habit with that. Automatic savings each month. Doesn't have to be a lot, can just be a few pounds, but you can set up from your current account, maybe on the day that you're paid. So that could be monthly, that could be weekly, it depends on when you're paid, but just put a small amount into a savings account. And that is a really powerful money habit, because that will quickly build up without you noticing. And if you don't notice it, maybe you can increase it. So if you start with £5 a month, can you move that up to £6, £10, and so on, depending on what you can do. So I think that's really powerful. And there are apps that help you save. Now, I've given an example of Sprive. So if any of you have a mortgage on your house, Sprive is an app that was started to help people pay down their mortgage quicker and quickly. Now they have lots of different services on there. For example, they can help analyze what's going in and out of your bank account, and maybe I would say, oh, you can afford to pay £10 off extra on your mortgage a month. They also have links to dozens of retailers, and you can generate vouchers. So if it really helps with intentional and mindful spending. So if I'm going to spend some money, let's just say M&S, so I'm going to buy some school uniform for one of my children or something, and I'm going to spend £20 at M&S, I generate a voucher from Sprive, and Sprive then put a percentage, I think M&S is about 4 or 5%. So, and they put that into my Sprive account, and then I can click a button and then it goes and overpays my mortgage. So it's really, really good on that. If you know anyone that's got Sprive, they will also be able to generate a voucher that can get you your first £5 on that for free. So you can find people that have got that, and you already got an extra £5 off your mortgage before you've even done anything. So that's also quite useful. Okay, so on to 2025. Let's start focusing on that. So there we go. Right. Top 5 for 2025. A rainy day fund. I've even put an image there of a safe. This is so important. Everybody needs a buffer. And actually, majority of people in this country do not have a single penny set aside for emergencies. We all need that. It's difficult to have money in a bank account, even if it's got a good rate of interest, sitting there, not doing anything. It's difficult if you are a spender and you see it there and you find it really difficult to think, oh, there's a lot of money there and I should be spending that. It's also really difficult for even someone like me who's like sitting there seeing this money and thinking this money is not working hard enough for me. Well, actually it is working hard enough for me, because I do not know what tomorrow will bring. But if it does bring something bad, whether that's just the boiler breaking and it's been really cold, if my boiler breaks, I'm going to need to get that sorted out sooner rather than later. If you go and do what I did, which is scratch up the side of my car because I wasn't looking last week, that's going to cost money, whether that's just excess on insurance or anything. So having money in a rainy day fund is really important. So rainy day fund, okay, what does that look like? Needs to be in an easy access savings account. If an emergency happens, you're going to need to get hold of that money very quickly. You need to be getting and earning interest on it. There are very few accounts under 4% that are worthwhile even considering. If you've got a savings account with one of the big banks, chances are you are getting a return of less than 3%, or even if it's in your current account, you're getting 0%. There are lots of savings accounts out there that are easy access, dozens of them, that will be paying you more than 4%. And right now, that's actually greater than the rate of inflation, which means you are actually in a bit of a vortex at the moment, in a really unusual situation where your rate of interest is higher than the rate that prices are increasing. Won't last that long, but your money needs to be at least working for you and getting an interest rate of more than 4%. I like to suggest cash ISAs. All that cash ISA is, it's just a savings account that has no tax associated with it. Even if you have everyone's got a personal savings allowance. If you're a basic rate taxpayer, it's at least £1,000. It may be more depending on what your earnings are. So chances are you're not going to be paying tax on it. But for me, there's a psychological barrier to taking money out of a cash ISA, because you're using an allowance and because it's tax advantaged and it's got a little wrap around it. So I like using cash ISAs. How much should be in your rainy day fund? I will never and can never tell you how much to put in there. And that's why I've said it's whatever helps you sleep at night, okay? But if you're like, you don't know where to start, think about 3 months worth of essential expenditure. So how much do you spend every month on your bills? So on your heating, on your food, on your insurance, all of these things that you have no choice. Whatever happens, you are going to have to pay them. So times it by 3 for your 3 months, and that's the absolute minimum. Okay, and just remember, you're not allowed to touch it unless you absolutely have to. And do not worry if you don't have one. You're not expected to magic it out of thin air. We talked just before about savings methods and ways that you can save. Those are all brilliant ways to help get you starting to save for your emergency fund. Okay, let's go on to number 2, budgeting and decluttering. Okay, let's work out, how do you declutter your finances? Now, in a very similar way to how you may declutter a drawer or a room, our finances can get really, really messy. And even if you have neatened them up and decluttered them, they need regular spring clean. Okay, so I put on here a handy list on how you can declutter. So it starts with making a list of what you are spending. Okay, the way to do this is to have a look at bank and credit card statements. Basically, there's no easy way to do it. If you spend, I've got 3 children, 2 dogs, there's lots of us here. There's lots of spending on all manner of things. So it's difficult. You will have lots of things you're spending on every quarter, every 3 months, or even every year. So the best way to do it is to get a year's worth up and just to have a look through and see what you're spending money on. So make a list. You don't have to make a list. You can just just get bank statement. If you've got an online statement, makes it very easy because you can usually do a bespoke timeline from this time to this time. Okay, have a really quick look through it. Maybe take a highlighter pen if you're going to print it out, or do it on your screen and you can draw and highlight it on the screen. Is there anything there that you just do not recognize? If you don't recognize it, put a ring around it. Okay, then you can go and find out, what was this? What was I spending on? What happened? You know, okay, that's the first thing. If it's something you don't recognize, you can then, if it's a direct debit, a subscription, or something that you accidentally did, or something that the kids went and did without you knowing, or anything like that, you can then go and cancel it, even see if you can get a refund or anything. So give you an example, I do this regularly and I still get caught out. I saw something on there that my son had obviously got on his Xbox. So I went onto Microsoft and they refunded me for an entire year's worth of this. So that was a lot of money back into my account as well. And then of course, anything like that happens, put it in your savings account towards your emergency fund or towards something else. Okay, next thing. Okay, you've got rid of everything you don't recognize, or you now recognize everything on that list. Okay, all sorted there. Now, do you need everything? Is there anything on there that actually you just don't quite need? So I'll give you another example. Was when I realized that I had two insurance covers, one for a boiler and one for all the plumbing in the house. Interestingly enough, I called up just to double check. That plumbing cover that I had was also for my boiler. So I had some duplicate, didn't need them both, got rid of one of those. Do you need it? Even if it's just something like, for me, again, looking through it, still have my Audible subscription. It's like, do you know what? I actually don't need that. I'm not really listening to any books anymore, and I haven't got any for a few months. So if you don't need it, cancel it. Okay. And then finally, is everything on there the absolute best price that you can get? So mobile phones are a really, really good example of this. We all go outside of our window, outside of our contract period, and it still stays at a really high price when we could literally get for a fraction of that price a SIM only plan. And it happens with a lot of subscriptions as well. Keep looking around for the absolute best price as well. So, and then the final part on the list is maintaining it, which is what I do as well. One way that can be really helpful, by the way, with maintenance is using those roundup accounts. Roundup accounts take an input from all of your credit cards and all of your bank statements, anything you spend on, and you get a note and then it rounds them up, but you get to see it in a list. And if you're looking at that every day or so, looking at it, thinking, do I recognize this? Do I need this? Is this the best price? Then you are automatically maintaining it. And also, you're looking out for fraud. I spotted a huge whopper of £5,000 plus fraud on my credit card last year, and I spotted that through my roundup account. And thank goodness I did, because it was the day before the money was going to leave my account. Funnily enough, the money wouldn't have been there, and so I would have been in a real financial pickle. But I was able to call up my credit card company in time for them to put it onto the suspicious list. So lots of ways here to declutter and to maintain it whilst also maintaining healthy finances. Just with budgeting, all I want to just put onto that, but a lot of people don't like budgeting, so I like to call it a little bit like a spending plan. Any lump sum payments that you have throughout the year. So Christmas, how much does Christmas cost you? Is December really, do you spend the same in December as you spend any other year? Do you have any months where there's birthdays? Do you have an annual season ticket for the trains? Do you go on holiday once or twice a year, or spend something on a birthday? Anything like that. Spread it out. Start 2025 and think, what am I going to need to spend more than the usual on? If you're going to be spending more than usual at Christmas, put £20 a month aside for Christmas. You'll get to Christmas and you will have £240 all to spend on Christmas. However much it is, you're then not taking out credit cards, paying off high interest rates on that. So really, really powerful stuff here, but also quite simple and really good to kind of maybe start 2025 with, having a think about, you know, 2, 3, or just one lump sum that you need to pay and spread it out throughout the year. Okay, let's talk about protection. Do you have a will? Okay, some myths about a will, by the way. Wills are for everybody. You do not have to have money for it to count. You don't have to need to pay inheritance tax or anything. A will is something that follows your wishes when you die. It's a really horrible topic and I'm really sorry to talk about it, but the fact is that we can't predict the future, but we can prepare for it. Now, having a will ensures that your wishes are not only followed, but those who are left behind aren't left with a lot of stress, a lot of potential and highly likely financial issues, because if you don't have a will, it costs a lot of money to just even gain access, and just a lot of time to even just gain access to your bank account. So if you've got those lovely savings accounts that you've looked at, maybe you've got a pension, maybe you've just got anything of yours, it will take a long, long time for any of your loved ones to be able to get that. And it could cost them a lot of money, and even more money to get at something than actually is there in the end. So a will is really important, particularly if you've got children. Who's going to look after them? You'll be very surprised about where your money may end up going, because it may not end up going to who you think it's going to go to, and a will make sure that that's followed. Other things to do with protection: ask yourself these questions, and I've put them on here. What if you're too sick to work? So how will you pay the bills? How will you get food? What if you die? Who relies on your income? And also, what if you're diagnosed with a serious illness? Can you afford to focus on yourself, or are you going to have to work through it because you're in trouble with that? What I did here was I put together a little risk reality calculator. This is for me. It's not actually for me. I've just read it. It's actually for someone who's younger than me, but not that much. I'd like to think it was for me, but it's not. This is the percentage likelihood that something's going to happen to a 45-year-old woman before she reaches the age of 67. So there's a 4% chance of death, so a 1 in 20. There's 11% chance of being diagnosed with a serious illness. And there is a 1 in 3 chance of being too sick and unable to work for 2 months or more, with basically a 38% chance of something pretty awful happening. And that's really scary. So just have a think, what would happen if any of those occurrences happened, and what you can do about it. And don't panic if you don't know what the answer is, because again, there are things that you can do about it. You can speak to professionals, you can look, and that's exactly what Paapo is all about as well, is making sure that you've got all things in place for the unexpected, as well as building these powerful money habits. Fourth, so the penultimate one, so we're quickly going to look at, is pensions. State pension. I've put a link on here, but you can just Google, by the way, check state pension or state pension forecast. Check your state pension forecast. And if there are any gaps, don't necessarily have to fill them, but speak to someone and see if they do need filling. This was what I checked last week. I always check mine. And for some bizarre reason, I apparently have a huge gap from last tax year, meaning that's potential that I won't get a full state pension. Now, that is actually incorrect. So I am, as you can imagine, it's me. So I'm already on the case with the Inland Revenue and getting them to rectify it. If you don't check it, you'll not know if there's any mistakes. But also, you need 35 full years of national insurance contributions to qualify for a full state pension. A full state pension is currently £11,500 per year for the rest of your life from your state pension age. So know what you've got. If it's worth filling in the gaps, if you've got some gaps, but you've still got 20 years left to work for it, and you've only got 10 years of gaps, do not pay money to fill it. You can always worry about that in the future, but keep a check on it and just ask someone, just get some help if you're not sure. Okay, if you are in a job where you have the opportunity for a workplace pension, I know it takes money out of your payslip at the end, but it also enables free money. It enables your employer to put money into your pension. So opt in if you're not already opted into your workplace pension. All right, really, really important. Pensions are so powerful, so important, and are amazing ways to save for your future. Okay, maximize your pension contributions. Okay, they help reduce the amount of tax that you pay, and I've put here an awful question. Okay, what would happen if you live too long? Okay, now just let that question sink in. Nobody in their right mind should be asking anybody that question, because that shouldn't be an issue. Living too long, no one can live too long, but financially you can, because you can run out of money. And the problem with the state pension is that if you just get a state pension of £11,500 per year, and that's assuming you've got 35 years of national insurance contribution, so you need to make sure you will still be living under the minimum standard of living. You will still not have enough to live on, and will need to either try and get benefits, or will literally be struggling through your retirement, which should be your best years because you've worked so hard. It's time to kind of stop and let that money that you were working hard work for you as well. But so really important, why you should maximize your pension contributions. There's something called the gender pension gap, and that is the fact that women on average have less money to see them through their retirement than men. Now, women live longer than men, and also women have higher medical bills than men. So women actually need more money to see them through. Now, this is the average person, but the fact that women have a third to a fifth of the amount of money to see them through retirement than men, that can cause significant issues. So it's really important that we understand what gaps are out there, and that we feel empowered and in control of our finances to make sure that we can lead a future life that we've earned, and that's right for us, and that means that that our money's been working for us. So I say, when it comes to pensions, know what you have. Just don't worry, I'll keep it on that next slide, but know what you have, where it is, and how it's invested. If you've worked for more than one employer, you're going to have more than one pension. Make sure you know what you've got and where it is. There's something like over £20 billion of money in pensions in the UK that have been lost and that have not been claimed. Okay, it's worth something ridiculous like £10,000 to £13,000 per person. That's a lot of money. If I were to ask you all, what would you do if you had £13,000 given to you that you didn't know you had? Okay, I think we all know what we would do. We'd do a big happy dance and everything. So know what you've got, where it is, and how it's invested. And don't worry, you're not alone. There are people to help you with this. My final thing for 2025, talk about money. Do not underestimate the value of and the impact talking about money has on you. It shouldn't be a taboo topic, but it is. It is healthy to talk about money. And I've written here, there's no need to divulge your financial secrets, your salary or anything, just the topic of money. You know, I've not stood here, told you all of my financial secrets, but I'm talking about money. That's really healthy. Talk about it to your partners. Talk about it with your children. Financial education. Oh my goodness. Always talk about it. Have money dates. Okay, it may not be the most romantic date that you'll have, but have a date over dinner once a week where you're talking about money topics. You can talk about savings rates, talk about savings accounts, talk about a money habit that you've just instigated, talk about some money you've just saved in the shops, talk about money. Make sure it's not taboo. That's the most powerful thing I think that we can do with our money. And really, you're not alone. Speak to a professional. I speak to people about money every single day. Yeah, get control of it. And here to help. That's it.
Thank you, Naomi. I think that was really, really fantastic. And I agree with you. It's so important for us all to talk about money. Money is it's kind of like a taboo topic. And sometimes when you talk about money, people just roll their eyes. Well, actually, every day we go out working for money. So it's really, really important that we talk about it. So now, everyone, we're now going into the Q&A session. So if you have questions, that you'd like to ask Naomi, this is your opportunity. So feel free to you can turn on your camera if you want, and if you rather not, either way, just ask the questions. But Naomi, I'd like to go first actually. There was a question I had. You talked about how pension contributions can reduce our tax liability. So if you could just, provide some more color around that, I think that would really be helpful.
Okay, brilliant. Now, there are two main ways you can pay into a pension. One is through your employer, through your workplace. And if you do that, so the money goes straight from your salary into your pension. Okay, so it misses out the tax. Okay, now there are two different ways it can go. One can be before national insurance and one can be after. So, and they're called, before is salary sacrifice and after is called net payer method. Don't worry, you can, if you contribute through work, you're missing out the income tax altogether. Okay, so £100, that's what will go into your pension, no income tax on it. Okay, if you take that £100 out and so you just get paid it in your pay slip, forgetting about national insurance because just it complicates things, but if you're a basic rate, and I'm not going to do all the calculations here with everything, but if you're a basic rate taxpayer, that is 20% tax. So you're paid £100, you get £80 into your bank account. Okay, if you put that into a personal pension, what happens is you get automatic basic rate tax relief. And I say, think of it like a magic door or a filter. Okay, and this is it. It's going to be my hand today. You've got your £80 and you put that into your pension. But like magic, what comes out the other side? Do it like that. There you go. It's like magic. What will appear in your pension will be £100. It's automatically done. Okay, so you automatically get that 20% on. So you put £100 in, it becomes £125. You put £1,000 in, and so on. It keeps going up. Okay, if you are a higher rate taxpayer or an additional rate taxpayer, you will complete a self-assessment tax return, or sometimes you don't have to. You can just write a letter to the Inland Revenue and they will then just change your tax code to take into account what you're contributing in. And then that extra, so if you're a higher rate taxpayer, 40%, that extra 20% is then put through your tax code and you just get your tax relief that way. It's that simple. It's absolutely brilliant. Now, when you start thinking there are lots of ways that you pay income tax, lots of ways that it can help, depending on your situation. But there are lots of different tax sinkholes as well. So if you receive child benefit, but one of you or your partner receives a higher income, you could start losing that. But if they were contributing into a pension, you could get your child benefit back, or you could get your personal allowance back above 100,000, for example, as well.
Okay. So we have, thanks for that. We have some more questions in the chat. So Olayemi has asked that, are there any benefits in merging your pension accounts if you have two separate ones? And
Okay.
yes,
Yep.
yeah, and there's another question on pensions. I thought it would be good to merge it. Then Omakolo also asked that, can you speak more about private pensions?
Okay. Okay, really good questions. And what I would say, if you've got two pensions, is there an advantage to consolidating them into one? I will talk about, first of all, I'll talk about the disadvantages, okay? Some pensions have protections or even what we call safeguarded benefits on them. So not all pensions are equal. If you've got a pension from before 2006 in particular, there is possibly some protections in that. So for example, if you know that a pension, when you're ready to retire, you can get 25% of it without tax on it. A while ago, so 18 years ago, some pensions were more than 25%. I'll give you an example. My first employer, I've got a pension with 75% tax-free cash. So if I were to merge that with another pension, I would lose that and it would become 25% tax-free cash. So that's one reason not to. Okay. Other reasons, there may be other reasons as well. Maybe the fees, depending on which one would you merge it into. Maybe some of them have got different choices of funds, and different benefits and advantages. So before doing anything like that, it's definitely worth speaking to a professional, or at least double checking and calling up your providers. But usually, if you're the sort of person, I said, know what you've got, where it is, and how it's invested. If you've got two pensions, now I know I have clients, or clients that used to have 4, 5, 6, 10 plus pensions. However organized you are not going to be able to keep track of that. And that's going to be very stressful. And in fact, the other thing is, usually different pension funds will have different investments. So you're basically guaranteed, if those two pensions you mentioned, chances are, well, definitely one of them's not invested right for you, because they're not going to be invested in the same sort of place or the sort of fund. And chances are they're both not. So it's important to have a think about that. You may be able to reduce fees, be easier to keep track of, and you'll be able to focus on how you're invested. But unfortunately, it will be it depends, and speak to someone about it. And that's where we go on to talking about private pension. So a personal pension is different to a workplace pension in the exact way that I said. Workplace pensions tend to be much more basic. Okay, you may be restricted on some of the things that you can do with a workplace pension, but as a receptacle for your employers and your contributions, it's brilliant. So don't knock them. They may be basic, but they do exactly what you need them to do. You may find that personal pensions are a little bit like that as well. And some people say it's actually not a bad idea to have a personal pension, because it's outside of your workplace. You may be able to control it. You may be able to put little lump sums in it as well. Not may, you will be able to put little lump sums in it, as and when. We were talking about savings. You could also have savings accounts, and if it gets to a certain level, you've got your emergency fund, you've got all your different savings pots for Christmas and birthdays and your season ticket, and maybe you've got another savings pot that you're just filling up from your roundup accounts or from wherever. Maybe when it gets to a certain point, you want to just put a bit of a lump sum in. A personal pension is a really good way of kind of controlling that. Okay, so I think that it's not a bad idea to have those two if you've got those options, or to have that one that you can control and you can put a little bit of money in. got a little bit of money here, you can put a little bit of it into your pension. So
Yeah.
they help with that.
Yeah, thank you. Thank you for that. And Tatiana also had a question about private pensions as well. She said that if I am a non-resident, when I receive a private pension, workplace one, can I still receive it? So I think her question is if you're a UK non-resident and you have a private pension in place, will you still be able to receive it?
Yes, you will be able to. Now, it depends where you're non-resident. You will as well with state pension, by the way. You build up your state pension, you absolutely can. There will just be some different rules around taxation and everything for obvious reasons, depending on where you will be living at the time. So you'll need to ideally get some sort of tax advice or some sort of advice onto the best way to receive it. But absolutely, that's your money. So not an issue at all. So you're not going to be saving into it now and then not able to access it in the future. You absolutely will. Don't worry.
Okay, fantastic. We only have time for one more question. So if anyone has any more question, they should ask now. I think pensions is quite an interesting area. So maybe we need to have a session on
Yes,
pensions because it's quite complicated. So
it's so complicated. Yeah, I actually I've got little articles on my website, and one of them is the P word because it fills people with dread. Have we got another question?
yeah, not well, none at the moment. So I think
Okay.
we're almost there. We're almost there. Thank you, everyone, for your patience. So I think what we now need to talk about now is Paapo. Would really like to use this session to introduce Paapo. So Paapo was founded in 2024. I think we're only about 4 months old, so we're still kind of like a baby. What is Paapo? Paapo is a social enterprise, and what we're focused on is building financial resilience amongst Black, ethnic, migrant and refugee communities because we feel these communities are quite underserved by the financial services sector, and this is a problem we are trying to solve. And how are we going to solve this problem? Via bite-sized financial educational content. Our website has just launched today, so you should check it out, paapo.co.uk. We will be providing helpful tips and tools for you through our website. Then we'll also be doing these webinars quite regularly. We're hoping that we'll have another session, probably late January, early February. We'll let you all know. And we'll also have community events as well. And we've also launched our WhatsApp community, and we want you to try and join. Anything relating to personal finance, if you really want to gorge on it, it will be in our WhatsApp community. And Naomi also will be part of the community, so you can ask her more questions there as well. And finally, what we are also planning to launch at some point next year is our app. So we're going to try to help to facilitate a savings habit through savings circles. So you need to watch this space. So thank you again. I am going to pop our link to our WhatsApp community into our chat now so that you can join. And also we have the QR code on screen as well, so if you put your camera there as well, you can check that out as well. And we also have an Instagram page. Please follow us. Thank you all so much for joining today. It's been a very interesting session, and thank you so much, Naomi. You really dropped some gems for us today. So thank you, everyone. Have a lovely evening and a very Merry Christmas, and hopefully I'll see you again in the new year. Thank you, everyone.
Awesome session. Thank you. Thank you.